Gold just hit $3,452 per ounce, a new all-time high. But this isn't just a fluke, and it's not over yet. What's really driving this surge? It's a perfect storm of fear, policy, and power plays. Let's break it down. Tensions between Israel and Iran have reached dangerous levels, and whenever the world gets unstable, gold shines. Investors worldwide are pulling out of stocks and currencies, pouring into gold as the ultimate safe haven. Result? Spot and futures gold just exploded to $3,452.80 per ounce, a record, and it could go even higher. But there's more to the surge than war. U.S. inflation is cooling. May's Consumer Price Index just plus 0.1%. And now, Wall Street's betting the Fed will cut rates as early as September. Lower interest rates weaken the dollar, and when the dollar drops, gold goes up. Behind the scenes, central banks, especially China and India, are buying gold at record levels. In 2024 alone, over 1,000 tons were added to global reserves. Some countries now hold nearly 20% of their central bank assets in gold. Why? They don't trust the dollar. They're preparing for something big. So, what does all this mean? Geopolitical chaos, rate cuts, global distrust in fiat currency. All signs point to one thing. Gold's bull run has only just begun. Are you watching from the sidelines or already in the game? Fundamentals are strong, but the technicals, they're screaming opportunity. Let's talk levels. Gold's first layer of support is at $3,297, aligning with the 38.2% Fibonacci retracement from the recent rally. Then comes $3,315, where the 21-day moving average sits, a popular buy zone for swing traders. Deeper support lies at $3,279 and $3,232, backed by the 50-day moving average and 50% Fibo level. If gold dips, these are the zones where buyers could jump in. On the upside, resistance builds around $3,377, the 23.6% retracement, and then the psychological level of $3,400. But the big one, $3,439 to $3,452, the double top zone from May to June. If gold can break through, we're looking at a retest of the all-time high at $3,495 and beyond. Let's decode the momentum. The RSI sits at 57 to 60, bullish but not yet overbought. MACD is still in positive territory, showing a continuation bias. And stochastics, they're approaching overbought but haven't crossed yet. Translation, bulls are still in control, but we're nearing a decision point. Zoom out and you'll see it. A bullish flag pattern broke out above $3,346 to $3,350. Textbook move. Now gold is consolidating between $3,335 and $3,440. This is healthy. It's not weakness, it's accumulation. If momentum holds, we could be gearing up for the next leg. Whether you're a trader or long-term holder, the signs are clear. Gold's not done, and this could just be the calm before the next breakout. Now that we've covered the fundamentals and technicals, let's talk action. Here are the top trade strategies for gold between June 16 and June 22. The first setup is simple. Buy the dip. If price pulls back to the 33.15 to 33.30 zone, that's your buy signal. This area is backed by the 21-day moving average and the 38.2% Fibonacci retracement. Set a stop loss just below 32.97 to protect against the breakdown. Target 3400 for partial profit, and extend toward 34.40 to 34.95 if momentum continues. Setup 2, the breakout buy. Watch for a daily or 4-hour candle closing above 33.77 to 3400. This would confirm a bullish continuation. Place your stop below 33.60, then aim for 34.40, then 34.95, and possibly even 35.50. Now, if gold fails and breaks below 32.97, you may consider a contrarian short, but be warned, the trend is still bullish. If you go short, look for downside targets at 32.79 and 32.32, with a tight stop above 33.30. Only trade this setup if you see confirmation,
like strong volume and rejection candles. Here's a quick snapshot of this week's gold trade setups. Pause if you need to take notes.